So I'm going to talk about housing and land and finance. My sort of passion is really the relationship between these very important aspects of modern capitalist societies. And as was mentioned by Peter, I have just, the two books I've written on this, which you can see on the screen now, both deal with it in a slightly different way. Essentially, the book I wrote last year, co-authored book, was a sort of treatise on how economics had forgotten or neglected the role of land, and also with the result that policy had also rather forgotten it, because unfortunately, or some in the audience might think fortunately, economics has an extremely strong role on not just economic policy, but also social and public policy, including housing policy. And the book that came out in the UK just last Friday, I understand will be available shortly in Australia. So yeah, sorry it's not here tonight, but it should be soon. The key question I'm going to try and address is to sort of answer the puzzle that this chart shows. And what this chart does is it's taking the average of 15 advanced economies, including Australia and the other sort of OECD major countries, including the US, Europe, etc. And it is indexed against the long-run average, and it shows the price-to-income ratio. So house price-to-income ratio is really the best measure of affordability that we have of housing, because of course you can have rising house prices, but if income's also rising, then affordability doesn't actually change. But this is a sort of nice proxy for affordability. So the long run average is the dotted line, 100, across all of those countries. But what you've seen is, and you see up to about the late 90s, there's some evidence that the affordability is in some sort of equilibrium around that long-run average. We had a bit of a boom in the late 80s and came down again, but then we went up again, etc. But in the run-up to the financial crisis, we really pushed affordability levels into sort of crisis zone. But the most interesting thing, of course, is that post-crisis, we had this enormous house price crash in most advanced economies, not here in Australia, which is an interesting thing to discuss perhaps in the Q&A. But the crash didn't result in a return to that long-run sort of equilibrium affordability level. And since about 2012, the general pattern in advanced economies has been this sort of very sharp upward trajectory. Now, of course, some of this is about stagnating wages. In fact, we have had stagnating wages since the 80s, actually. But clearly, we've also had very high and rising house prices, which you know all about here in Australia. And just to give you the detail, I've mapped Australia here in the blue, and you can see that Australia is well above that average on the previous slide. Your house prices didn't come down very much at all post-crisis, and they've been shooting up spectacularly fast, the house price to income ratio since 2012, 2013, faster basically than anyone else in the world. But you've been in good company, because the UK is not far behind, and Canada also is nearby. So it's actually the thesis I'm going to present is that this tendency is a feature of Anglo-Saxon capitalist systems. It's actually inherent in the wider economy, and it's particularly to do with the financial system. So yeah, little sign of that affordability ratio coming back to that long-run average. A result of this has been a decline in home ownership. The dream of the home-owning democracy that was so central to Margaret Thatcher's vision and Ronald Reagan's vision of free market capitalism. If you work hard enough, you'll be able to own a home of your own, have a stake in the capitalist system, throw away the dependency on the state. That dream is under threat, as this chart shows very clearly. Since the 2000s, essentially things peaked really in the late 1990s, 2000s. In fact, they peaked even earlier in New Zealand. Your cousins across the waters, home ownership levels been declining since the early 1990s. But in general, the pattern is that there's this peak around the late 1990s, 2000s, around 70% home ownership, and that's now shifted down to closer to 65. And the trajectory in the forecast is for that to continue. So something's gone wrong with the dream, with the model, and that's what I'm going to sort of explore with you over the next 40 minutes or so. Now, the key to sort of understanding this is can be explored by thinking about what the classical political economists focused on more than anything else, and that was this notion of economic rent. And Adam Smith, the founding father of free market economics, usually seen as a bastion of liberal free markets and free capital, free trade, etc. Adam Smith put this at the centre of his concerns about the functioning of the capitalist system, because he recognised that the price of land, and thus housing, because land values essentially determine about 80% of house prices. There's been a nice study that looked back at sort of, I think, about 150 years of data and found that certainly in the last 40 years, about 80% of house prices are determined by changes in land values. And he recognised that the market mechanism didn't work effectively when it came to land. That it was impossible to have a genuine competitive market for land. As he says, the rent of land, therefore, considered as the price paid for the use of the land, is naturally a monopoly price. It is not at all proportioned to what the landlord may have laid out upon the improvement of the land, but to what the farmer can afford to give. Okay? So land is a natural monopoly type commodity. And basically, the challenge of economic rent is that landowners, as the economy grows, by increasing the rents they charge on the land that they own, they can absorb the additional value created by the workers, the tenants, who live on their land. And more broadly, when economic development takes place, when there's a new tram system put in, when there's a nice new school built, when a fantastic new vegan cafe with great flat white coffee opens up around the corner, all of these things raise the locational value of the area, the land value. And if you are lucky enough to live there, or be a landlord who owns a property there, you can raise your rents, absorbing that value. And the problem that Smith and also David Ricardo, John Stuart Mill, and Marx, all of the classical political economists recognised, was that if those rents became too high, they would begin to absorb a larger and larger share of workers' and businesses' incomes, and that would prevent sufficient consumption and sufficient investment to keep the economy moving over and growing. Okay, so actually land rents were a direct threat to growth and to free markets and to competition. And there was broad agreement between economists from completely different spectrums about this rent problem. The disagreements were about what the right solution to this problem was. So Marx favoured and Proudhon favoured nationalisation of land, socialise and nationalise those rents. the great liberal economists, the British economists, well, Smith was Scottish, let's be careful. Smith, Mill, Ricardo favoured taxing land. They actually argued that the bulk of the tax base should come from those rents, that increase in the value of land, rather than income or consumption taxes. It should come from land, because that would be the most efficient form of tax. And I'll talk more about that as a solution in the later part of the talk. Now, of course, when the classical economists were writing, mostly land was used for agricultural purposes, and Ricardo's concept of the marginal productivity of land, his argument was basically that the rent would be determined by how much the farmer was prepared to pay for a piece of land that was owned and developed, vis-a-vis getting his own piece of unused land and developing it himself. Essentially, that was the marginal productivity of land. Today, land is mostly used, and has been for some years now, as a place where people live and work. So housing is the main use for land. So homeowners, how many of you are homeowners? Put your hand up. Own a home. Right, you're also rent extractors, sorry to say, but homeowners, particularly in countries like Australia where there's no tax on capital gains, are also absorbing rents. You also don't pay imputed rent, whereas if you're a renter, you're paying the rent to the owner of the land. So we need to think quite seriously about what this means for home ownership. Now, why isn't there more tax on the value of land, or the increase in the value of land in this economic rent problem? Well, I think mainstream economics has a lot to answer for here, because around about the late 19th century, early 20th century, when mainstream neoclassical economics started to dominate the discipline, there was a shift away from this classical political economy perspective. The idea was that actually the true value of commodities derived from people's subjective preferences expressed in the price mechanism through free exchange. In contrast, the classical political economists realised that rents could generate money and wealth, and that this was a problem, because it was nothing to do with free market exchange. It was to do with monopoly power, as I've explained. But the neoclassicals didn't support that position, and the idea began to develop that property rights were necessary to free market exchange, which they are. It's very difficult to have an effective market with no property rights. But they were presented or theorised as naturally occurring. And the origin, the distribution of land and property was never really questioned. And this was to do with neoclassical theory, with neoclassical capital theory, which basically argued that although land may create some special kinds of fixed costs in the short run, because you have to build something, take some time, etc., in the long run, the marginal returns and marginal costs to land were not fundamentally different from the marginal costs to capital or to labour. Essentially, the unique qualities of land were sort of conflated together with this sort of quite fuzzy concept of an all-encompassing concept of capital. And John Bates Clark was the key theorist here. And there's a medal named after him, which you can win if you're a very successful economist over in the US. And essentially, the theory of marginal what he did was he extended Ricardo's concept of the marginal productivity of land and said it applied equally to all forms of capital and also to labour. That in the long run, they were all the same. And in the long run, income is reward for one's contribution to production, and wealth is the savings that accrue due to your effort your productive investment effort. And rent just somehow fell out of the picture. Unearned income, windfall gains from just happening to own some land in a place where the economy is growing. This was not seen to be important. So land was conflated with capital, but of course land is not capital. It's fundamentally different, a different kind of economic commodity. Land is inherently limited, finite in supply. You can't make more land. You can, of course, build taller buildings, and you can expand land by building railways, which shorten the distance from one place to another. So you can sort of create a city region, and that is a way of expanding land. But ultimately, what we're talking about here in modern industrial advanced economies, where the main purpose of land is housing, not growing stuff, not growing food. Location is what actually matters, right? And desirable locations will always be limited in supply. You always want to live a bit closer to where you work, or a bit closer to the centre of the city where the nice vegan cafes are. You always want your kids to go to a better school or be nearer to the school. So there is an inherent inelasticity to location. In a famous phrase of estate agents, location, 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 it comes from this concept. There's no such constraints on capital. The only constraints really are supply of labour and energy, as we're increasingly realise. Land is also fixed and immobile. Capitals are the opposite. A fundamental point is that land appreciates in value, as I've explained, with economic growth, whereas capital typically depreciates, although of course you have patents and you have intangible forms of capital, brands, etc. But obviously machinery, manufacturing, etc., typically and your house typically depreciates over time. Technological innovation also means that your car depreciates very quickly. And as I mentioned, ownership of land enables extraction of value from the rest of the economy, nothing to do with your own effort. Whereas rentier returns are somewhat more constrained in regard to capital. Again, patents can somewhat push back against that. The other key point, of course, is that land has multiple economic uses. It's a consumption good because we need to live somewhere. It provides a flow of services, enables us to get to work. But it's also a store of value. And increasingly, land and housing as a financial asset is becoming more and more important. And equally important, land property is a source of collateral. And the very reasons that I've talked through for why it's unique, in contrast to capital, the fact that it appreciates in value, the fact that it's fixed, you can't hide it, makes it extremely attractive for the financial sector, the banking sector, as a source of collateral. And that is a key feature. And that brings me on to the banking system. What do banks do? Well, again, mainstream economic theory and also the sort of policy world and I think probably most of the general public for many years assumed that this was the sort of model for how banks work. They take money from savers, your grannies and your hard-working savers, and they recycle, their intermediaries, they recycle those savings and give them to your jolly small business, your entrepreneur who invests. That's the sort of classic model, and that is very much what's in many textbooks until quite recently. That's what you were taught if you study economics. In fact, that's an inaccurate concept of how the banking system works. In fact, when a bank makes a loan, it creates an asset, the loan, which provides a flow of interest payments, source of income, and at the same time it creates a new liability, which is the deposits that appear in your account when you get a loan from a bank. And those deposits are a liability of the bank to you, right? So it creates an asset and a liability, and it expands its balance sheet. No money is taken from anywhere else in the economy. That's the magic of banking, fractional reserve banking. It is creating new purchasing power effectively out of nothing. And this was recognised by Joseph Schumpeter and by Keynes writing in the early 20th century. For Schumpeter, the banking system was the E4 of the capitalist economy. Without the creation of new purchasing power by bank credits, the financing of industrial development would have been impossible. So, whilst the neoclassical model of the economy was this circular flow of investment, the creation of goods, sale of goods to consumers, the consumers buying goods, and within the circular flow, that made it hard if you're an entrepreneur. I mean, if you're an entrepreneur, where do you get the money? Because you're outside of this flow. The banking sector provides the finance to enable you to compete, and it's this that creates dynamic capitalist economies. And Keynes similarly made the point that credit expansion by the banking system provides not an alternative to increased savings, but a preparation for it. So actually bank lending creates savings. It's not that the savings enable the bank to lend. They've got it the wrong way round. So that's a key area to understand. I've written a book called Where Does Money Come From? In case any of you want to explore that issue in more depth. What's very interesting is that we published that book in 2011. The Bank of England immediately invited us in to have a chat about this book. They liked it, basically, and they felt that they should probably publish something that said sort of something similar, because they'd never done it before. They'd never sort of come out and admitted that banks create money. And they did, actually. They published a paper called Money Creation in the Modern Economy in 2014, which I think is now one of the most downloaded central bank publications in history. And they quoted our book, which was very nice. And I noticed actually that the RBA has recently published something along similar lines, and the ECB, I think about 2 years ago or a year ago, even did a video animation explaining how banks create money. So suddenly central banks have found out how it works. So as I said, when a bank makes a loan, it expands its balance sheet. It creates an asset, which is the loan, which means you have to pay it, the principal and some interest. But it also creates a liability to you, which is the deposit. Now, that deposit can be used by you, to buy stuff, to buy a car, whatever it is. But in a sense, it is also savings. That is the money that's been created. And that is actually how capitalist systems work. The bank creates the money first, then that's spent into the economy. It ends up as savings. So the point is that loans precede savings, whereas in sort of mainstream economic theory, it's always been the other way around. And there's this very strong emphasis on economies with more savings and more productive, etc. So that was the point I was trying to make there. Now, how is this relevant to housing and land and house price inflation? Well, there's no guarantee that the new credit and purchasing power that banks create will flow into productive activity. The textbook model is that banks only lend to non-financial businesses for investment, for working capital. But in fact, as you're probably also aware here in Australia, banks can also lend for other things. And one of the main things they most like lending to is to households to buy existing property on existing land. Okay. Now, the dynamics, the economic effects, the macroeconomic effects of these two different types of lending are very, very different. And this, for me, is one of the most important concepts to understand if you actually want to understand the trajectory of modern capitalist economies. You've got two circuits of bank credit. You've got the textbook circuit. You've got a business that wishes to expand or invest. The bank makes the loan, the business invests it in production, in innovation, or it just pays its workers, hires new workers, whatever. It expands its activity. The result is increased investment or GDP transactions. Those workers get paid more, or there's a new invention. You know, obviously it doesn't have to go like that. You can have bubbles inside businesses as well. But generally, that's the model. Increased productivity is hopefully the outcome, higher wages, which means increased consumption, which means increased demand for goods and services, which means businesses want to borrow more and invest more. That's the sort of positive, very crudely, the positive cycle of productive credit. On the other hand, we have the not so positive or negative cycle, what I call the housing finance feedback cycle, rather long, sort of played with calling it the doom loop, but I felt that was probably a bit too controversial and might not be able to get in the Financial Times if I did that. Anyway, the feedback, the housing finance feedback cycle is very different. Credit is lent against, as I say, existing land and property. The result of that is an increasing burden of debt for households. You can't use your house to you can't use your house to increase the productive capacity of the economy, right? You're just going into debt. There are ways you can withdraw wealth from your house to fund consumption, which I'll talk about. But you're not giving money to businesses to actually enhance the productive capacity of the economy. So actually that increase in household debt has the effect of, sort of in the long term anyway, as household debt to income increases, not increasing demand in the economy, and potentially reducing the profits and investments of firms because people are spending less money in the economy, resulting in reduced demand for productive credit from those firms, and reduced wages, meaning people actually need more credit to buy property as land prices also increase. And the key argument really that I'm making in this presentation is that credit that flows into land, into existing land and existing property, actually pumps up land values and house prices because it's got nowhere else to go, right? It's just a finite, inelastic commodity, land, desirable location, with a non-finite, highly elastic supply of credit flowing into it, right? And so property price appreciation is the natural outcome of that, and that creates this feedback cycle, which I elaborate on a bit more in this slide. And the key argument really is that financial deregulation in Anglo-Saxon economies, particularly the US and the UK initially, and Australia I think was maybe 10 years behind, but you caught up with us quite quickly, led to banks increasingly shifting their lending pattern towards existing property, towards real estate. In fact, they didn't reduce their lending to firms, but there was the massive increase in bank credit that we've seen especially since the 1990s, but also from the 80s in Anglo-Saxon economies, has almost all come from increases in real estate lending. And that can be seen quite clearly in this chart here. You can see here from the late 1980s, essentially. It starts really in the 1990s, but if you go back to 1950, you can see lending to businesses, that's the orange line, considerably higher than lending for mortgages. But then in the early 1990s, you have this fundamental debt shift in what banks are actually doing. The majority of their lending shifts from supporting businesses, the textbook model, to mortgages, basically. And the key argument in the book, really, and in both my books, is that this is the great neglected reason why house prices have inflated. It's a demand-side problem as much as, or even more than, a supply-side problem, because you've got this massive amount of credit flowing into a fixed commodity. Of course, supply side is important in certain cities, in certain countries. Certainly we haven't built enough affordable housing in many countries in recent years, or for even longer. And in some countries, in the US, for example, there are certain cities where there's clear evidence that the planning system doesn't enable an elastic enough response to increased demand. And in Australia, I think there is evidence that you've had strong population growth, for example. So there are supply side issues, but for me, policy anyway, and economics more generally, has really neglected this demand side problem created by the deregulation of finance. And that is a problem. And I think it relates back to this fundamental misunderstanding of what land and money and what banks actually do. And as I explained, land's unique qualities make it an excellent source of collateral. So given the choice, a bank will sort of shift towards mortgage lending over business lending. Businesses have limited liability. If you make a loan to a firm and it goes bust, that's it. You've lost out. The loan's become insolvent. You have to eat into your capital to keep yourself solvent as a bank. If it's a house, you take the house, right? I mean, the risk is just lower for the bank. I've shown you the graphs, but the evidence supports this thesis that the deregulation of the financial sector was the most important driver of house prices. And these are two studies by the OECD and the IMF over many years, sort of 25 years, that support this thesis. The other thing is international regulations, the Basel regulations, which force banks to hold capital against their loans, have systematically favoured loans against property for the reason that the bank can, take property, and that households tend to, be at lower risk than businesses. But banks have taken advantage of that. And the other massive reason why is because the government has subsidised mortgage lending in virtually every advanced economy for many years. So that's the basic argument. But this slide basically summarises that shift, really. There's a sort of broader kind of shift. Two main eras of the way we've treated, from a policy perspective, housing and the financial sector and their relationship. In the post-war period, from up to about the early 1970s, again, this is some crude generalisation, but this is a basic idea. Consumption demand was driven by, people, the suburbanisation of cities, and housing played a key role in that, because housing created by the state meant people needed cars, they wanted white goods in their houses. It was a source of consumption, but it was the building of new housing and the need for new cars and stuff that generated the growth. In the post-1970 era, the neoliberal financialisation era, we're actually supporting, certainly in Anglo-Saxon countries, we're supporting consumption not by the purchase, not by the building of new stuff and expansion of transport or innovations in technology, but by withdrawing wealth from the increase in the value of our property, mortgage equity withdrawal. So it's a debt-based system, or a debt-based growth system, much more volatile, much more fragile, and resulting in high levels of inequality. Taxation has changed completely. There used to be tax on property, capital gains taxes. There was a tax on imputed rent in many countries, the UK included. And that was basically a tax that you had to pay if you're a homeowner to equalise the tenure with renters, right? So you would have to pay a tax on the rent you would have paid had you been a renter. So there was tenure neutrality between renting and tax. In the UK, we got rid of that in 1963. There was higher taxes generally on inheritance as well. Post-1980, gradual removal of virtually all taxes on primary property, and also mortgage interest rate relief in many countries, and I'll talk about some of the Australian examples. And tax shifts generally away from property and those economic rents from land towards income and consumption. Mortgage finance in this post-war Keynesian era was limited. The central banks had quantity and price controls, and it was limited in general to mutuals, building societies, thrift savings and loans societies that were insulated from the wider economy. Very conservative lending models. You needed a big deposit. You needed to be a member of the mutual for X number of years to get a loan. There was a strong relationship between who you were and your whether you'd be allowed to borrow. Today, a completely different system. Mortgage credit. All the big banks do mortgage lending. Building societies have been swallowed up by the larger banks. Massive consolidation in countries like the UK and Australia, where you have these kind of 4 or 5 massive mortgage-oriented banks competing really mainly around mortgages, and a huge expansion of residential mortgage-backed securities from the 1990s onwards, which means the banks can originate mortgages, package them together, and sell them on to investors, to institutional investors, meaning they can take them off their balance sheet and make money from the fees from selling them on. Completely different business model. Normally banks make money from the interest rate differential between what they pay to you when you put your deposit in and what they charge on their loans. Relatedly, the source of bank funding has changed. It used to be limited to the domestic deposit base, but post the 1970s, the collapse of capital controls, you have suddenly banks are able to access funding from the euro-dollar market, for example, in the 80s, and increasingly overseas investors buying up mortgage-backed securities. Vast new wholesale funding mechanisms open up to banks, enabling that massive expansion in mortgage credit that you saw in the previous chart. Housing policy used to be, in the Keynesian era, focused on subsidising the supply side, socialising those rents I was talking about by having large public housing programmes, compulsory purchase powers, much stronger control for the local and national state over land ownership and what gets actually built, focus on housing in terms of its use value. Today, the subsidies are all on the demand side. There's been a withering of public sector housing, the state selling off land, privatising land, and these huge subsidies for first-time buyers, etc. So the source of growth has changed. In the Keynesian era, it was private and public investment, banks lending to firms, the state investing in infrastructure and housing, rising wages, a positive cycle. Today, as I said, a debt-fueled private consumption model with stagnating wages. The result of all of this is that land rents are increasingly concentrated in older parts of the population, those lucky enough to buy housing before these huge expansion in house prices. And the banking sector monetizes an increasingly large share of those economic rents, because the banks, by pushing credit into land, leads to an increase in the value of that land. The landowner takes some of that, but of course, depending on how big the mortgage is and how big the interest payments, some of that rent is flowing back to the banking sector. So the bank is taking a proportion of those rents, and the more money it puts in, the more house prices go up, the more of those rents it's able to extract. So we have a very different approach now to rents. This is the Australian. I'm going to talk about Australia now for a bit. You'll be pleased to hear. This is the Australian picture. It's quite similar to the aggregate picture that I showed before, which was 17 advanced economies. But this is Australia. You can see exactly the same pattern. Around about 1990, you get this amazing divergence in, this is loans outstanding on the left-hand axis, credit outstanding as a stock of credit as a percentage of GDP. You get this amazing divergence where mortgage credit overtakes lending to firms, this productive credit, and continues on this upward trajectory. On the right-hand axis, I put real house prices, and you can see a sort of correlation there between the two variables. This shows you how land is really driving the whole thing. This is land price index against house price index. It's changes in land values and the volatility in land values that are the main driver, as I was saying, of house prices. And there's been this rapid rise in land. This is land value relative to GDP. And as you can see there, land values since the 1980s have increased by 3 times GDP. So those rents are getting bigger and bigger if you're lucky enough to own. And the result of this has been an increase in renting as affordability is reduced, and an increase in homeowners with mortgages, increasingly larger mortgages than they used to have. If you own a house today with a mortgage, it's going to be much higher than the mortgage your parents had, almost certainly. And so that's again the home owning democracy. The dream is over. As I said, the ratio of household debt relative to the stock of housing has massively increased. So one argument is, well, does it really matter that there's all this additional debt? Because the value of housing is going up, right? So we've got more higher value assets. So that sort of cancels out the debt. Well, if you look at Australia, very similar to the UK, that ratio has massively increased from about 10% to 30% in Australia from 1988 to 2013. This shows it's probably even higher now because it's really shot up in the last 5 years. But it's the same pattern in many advanced economies. So that again means that economies are becoming more fragile. The Australian government has supported this process by reducing taxes on property. There's no capital gains on primary residence. You have this very generous negative gearing where you can offset losses from property against your income. And the bigger your loan to rent, if you're an investor, the rent ratio, the more money effectively you get, supports higher wage earners effectively, means they can get out of huge amounts of tax. And in 1999, there was this 50% cut on capital gains for investors. So rather than pushing back against this phenomenon, the Australian government's essentially gone the other way and further subsidised this process. From an inequality perspective, of course, this is disastrous because what you have essentially is if you're lucky enough to be a property owner, you see your net wealth increasing, you have greater economic security, and as I mentioned, it's easier for you to borrow, to do mortgage equity withdrawal, to borrow to buy another house, be a bigger investor, and this cycle supports you to some extent. Obviously, it depends on how much debt you've got and what house prices are actually doing, but obviously in Australia, they've only been going one way for the last sort of 40 years. For everyone else, though, who doesn't own property, it means higher rents in most cases. It means you need to save more for a deposit, and it means you have less disposable income. So this model is an inequality driver, essentially. The level of inequality becomes much clearer when you look at the age dynamics. This is a generational inequality driver, and you can see that huge decline if you're under 35 in home ownership in Australia since 1981, from 60% down to about 45%, and also quite a sharp decline for the under 45s. If you're a bit older, you're still doing okay. In terms of net property wealth, if you look at it by income, this is the quintiles, you'll see that the gains have been much, much higher at the top end of the income spectrum than the rest. Again, a wealth inequality generator. Now, I don't want to be all doom and gloom, so I will talk now finally about some alternatives. And I'll focus my discussion here firstly on financial reforms, and then I'll talk a little bit about reforms to housing and land policy. So, financial reforms, let's start with what central banks have been doing and could be doing. So, central banks since the 1980s, or since the late 80s, early 90s, have been targeting inflation as their overriding objective, and using interest rates as almost the only instrument to achieve those, to try and achieve those inflation target. They've targeted quite a historically low level of inflation, around 2%, and they haven't been thinking too much about asset prices, house prices. The idea being that consumer prices is simply a more important economic dynamic. In the run-up to the crisis, there was some discussion. Our house prices seem to be getting very high, but the general consensus was better to let the bubble burst and clean up the mess afterwards, essentially. It was hard to know whether it was really a bubble. It wasn't the role of the central bank to intervene. Post-crisis, that's changed to some extent. So we now have this policy agenda called macroprudential policy, where some central banks in some countries have done things like raise the loan-to-value or loan-to-income ratios, so you need to have a bigger deposit, etc., to get a loan. And there's been some attempts to dampen down this house price, dampen down lending. But there was a very different regime in place in that Keynesian era from 1940 to 1970, where there was central banks actually really took seriously not just the total amount of money or the price of money, the interest rate, but where the money created by the banking system was actually going in the economy. And there was policies generally termed credit guidance or window guidance, sometimes more informal. Sometimes the governor just sort of, classic story in the Bank of England is the governor would just raise his eyebrow, and the banks, the sort of cartel of banks we have, would change their lending behaviour. And typically the sectors that were repressed, where there were stronger credit controls, were housing and consumer finance, because that was seen to be speculative types of finance that was seen to lead to asset bubbles. And the sectors that were favoured were typically manufacturing, exports, and other strategic industries where there was felt there would be the most growth and the highest levels of employment in the economy. So maybe we should be thinking of shifting back to some of those type of credit guidance and allocation policies. And there's some evidence of central banks today starting to reconsider this. So, for example, there's a network for greening the financial system made up of, I think, about 20 central banks. Not quite sure if the RBA is a member. I don't think it is. Fed is not. Fed is also not a member, so you're in good company there. But they're actually looking at how central banks might actually influence the flow of credit into green sectors of the economy to help decarbonise the economy. So there's perhaps some movement there. But these policies were used in Southeast Asia and Japan throughout the 1970s and the 1980s. China does it today. Each quarter they publish a list of all of the sectors that they're encouraging credit to flow into. Shanty towns, infrastructure, green energy, the list goes on. It's all the things all the areas that banks in countries like the UK and Australia are not investing. That's what they're doing in China. Obviously it's easier because a lot of the banks are nationally owned. So there's perhaps some room for optimism. The other structural reform that I think is needed, and maybe this is more for ministries of finance to take the lead on, is state investment banks. right? Public banks focus on investing in particular important sectors of the economy. Often their borrowing is not counted on the public sector debt against public sector net debt, because they're creating assets for the economy. Germany, for example, is one of the largest of these institutions in the world, the KfW Bank, which invests huge amounts of money in green energy and is a market leader in that area. Again, Asia has very large state investment banks. So that's one area. Another structural reform to the banking system is to think about that de-risking process. So when a bank makes a loan, loans are inherently risky. How do you de-risk your loan? Well, the types of banks that we have here in Australia and in the UK, and that are also increasingly dominating in Australia, in US and many advanced economies, are generally large shareholder-owned, publicly listed banks that are looking for 10% quarterly return on equity. What sort of loans do they want to make? Do they want to make small loans to SMEs, which are quite risky, which involve sitting down with the owner of the business and talking through their business plan and trying to get to know what's going on in the local economy? No, they don't want to make those kind of loans. They're too high transaction costs. They're too risky. They want to make big loans collateralized against property, right, where the risk is low, but the loan is large, thus the flow of interest is large. Or they want to make, maybe slightly riskier but larger loans to other financial corporations. Those are the two areas that we've seen this big growth. So what we need is banks that are prepared to do that kind of relationship-based lending rather than this centralized credit scoring model. And we did used to have more of these types of banks. Certainly in the UK, we used to have more regional cooperative banks that were more focused on the local economy. Again, in Germany, I'm afraid you have a lot of these types of banks, 30% cooperative banks in Germany, about 30% public savings banks, and about 30% large shareholder banks. In Australia and the UK, it's dominated by these big shareholder banks. In the UK, they have about 80% of all assets are concentrated in 5 of the big shareholder banks. I think it's probably similar here. So, how do you support different kinds of banks? This is the type of economy you have if you're a country like Germany, which has banks with genuinely different incentives. You see there lending in the green to non-financial corporations is productive lending. Stayed pretty steady around averaging 40-50% in that period from 1970. You don't see this massive shift with mortgage credit overtaking loans to businesses. And house prices on the right-hand side scale have been flat in contrast to all the Anglo-Saxon economies. So clearly they've got something right there which we can learn from. So that's financial reform. What about reforms to the way we treat land and housing? Well, I'm a big fan of the idea of land value tax. I think it, as most economists, even from the left to the right, this is the one thing they basically agree on: that it's highly efficient, that it taxes rents in a very efficient way. That it shouldn't lead. It doesn't have any deadweight loss. Basically, it won't stop businesses creating stuff or people buying stuff because it's a pure rental tax. Why has it not happened more? Basically, it's because of this hugely strong attachment to home ownership and the idea that we should be allowed to generate wealth from owning a home. We've got used to it. Our economies have become focused on asset appreciation. But there are ways that it could be introduced, and I think a key thing is the salience. So if you get a check in the post every quarter or every year for $2,000, that's not a popular way of paying a tax, but that's generally been how it's been introduced in some cases. It could be withdrawn at source from your income, like national insurance is in the UK. Milton Friedman advised this was how it should be done. And you could also make it tax neutral. Just to explain, sorry, in case anyone's not familiar, a land value tax would be a tax on the incremental increase in the value of land underneath your home, in the case you're a homeowner, over a period of a year, and it would be taxed annually. And the way to introduce it would be to get rid of other unpopular taxes. In the UK, we have council tax, and you have rates in Australia. You could potentially get rid of that. Maybe even reduce income tax and corporation tax if you want to get business on side with it. But essentially, these are less efficient taxes because they don't tax rents. They're taxing production. They're taxing consumption. They're taxing the good things. And the challenge, of course, is if somebody is asset rich, your older pensioners, how do you get around that? Well, you can allow them to defer payment until they pass away, or you can have a form of, some form of equity release. There are ways around that problem that can be dealt with. The other main area for reform, I think, is reform of ownership. Removing land from the market, public land, solves both supply and funding problems. It can solve supply and funding problems. Singapore is one of the most populous nation states in the world, most crowded. But 90% of land is owned by the state. It's famed for its low taxes, free market, bastion of free market economics. The state owns all the land, and they decide what gets done with it. They make long leases to the private sector for the things that they want built, for the developments they want to happen. So that's one option. In South Korea, they have a land corporation. It was created in 1975 that controls about 50% of all residential, 50% of residential and all commercial development. They purchase the land at agricultural prices, they develop it, and they sell the land on. They recoup the rents, and then obviously spend them on public services, whatever they want to do. So this is a very different model, this development corporation, a publicly owned development corporation model. Finally, and I want to leave time for questions, I think this issue of tenure is really important. So we used to have tenure neutrality in that, roughly speaking, in that post-Keynesian era. Today, most countries have massively favoured home ownership, as I've said, over renting or public housing or cooperative housing. Again, there are some exceptions. Again, Germany is an exception where I think it's about 40% or 50% even people rent. There is no stigma attached to rent. People rent, they have kids, it's not an issue. They have much stronger rights as a renter. It's very hard to get thrown out of your house in Germany unless you sort of mess it up. You can't be thrown out or you don't pay your rent. In Australia and the UK, you have virtually no rights. The role of being a renter has been systematically degraded and stigmatised over many years. And that needs definitely to change, I think, to address this problem. So I hope I've given you some positive ideas as well as spelling out the problem, and very welcome to have questions and answers.
Thanks very much, sir.